Welcome to the All Facts Matter podcast, where we push back against corporate media propaganda with facts, evidence, and data. I'm Peter, the author of All Facts Matter. Let's begin. Always be aware of the accurate prediction. If a prediction matches up with the exact value that is predicted, be suspicious of it, of both the prediction and that value. As the old saying goes, if it sounds too good to be true, it probably isn't. And that is the takeaway that we should have from November's Consumer Price Index summary. While it reported inflation matched Wall Street predictions, a closer inspection of the underlying data makes that match curiously convenient and therefore suspicious. Now, the headline number confirms that what I've been saying for a while, which is that inflation is on the rise. However, when we peel back the layers of data, we see that the reported headline inflation rate is probably higher than it should be. And we need to peel back those layers to understand what is going on and what the November CPI report is telling us. Now, as usual, those are the details which corporate media prefers to ignore. Those are the details which corporate media does not want to give you. Those are the details, however, which give the fuller picture of how inflation distorts and damages the overall economy. Now, on the surface, the Consumer Price Index summary was not at all surprising. As I had noted last week, there was going to be at least some inflation. The report certainly seems to bear that out. Headline and core inflation both rose to about 0.3% month on month. And as I had expected, food price inflation rose to 0.4% month on month. Now, we did get a couple of surprises. We got a little bit of energy price inflation, which was not supposed to happen. And we got a little bit more goods price inflation than we were anticipating, which also was not supposed to happen. And that we got these things which weren't supposed to happen is why we should peel back the layers and take a closer look at the data, because these are the anomalies that we want to understand to fully make sure we are getting a correct picture of what the CPI report is telling us. Overall, Wall Street wasn't interested. They took the inflation numbers in stride. They were not curious about them. They had largely priced in the higher inflation data the day before. That's why stock prices were down a little bit. And having done that, they were basically happy with it. They took the inflation report largely as just confirmation that the Federal Reserve is going to follow through with the expected 25 basis point rate cut in the federal funds rate when it meets next week. And other than that, Wall Street was far more interested in what Alphabet and Tesla were doing than what inflation was doing. As far as they were concerned, the inflation report was just a nothing burger. Now, that's kind of too bad, because what Wall Street failed to notice was that the actual inflation report was well above, printed well above what the Cleveland Federal Reserve's inflation nowcast projected. So especially when we look at the month-on-month data. The headline inflation rate month-on-month was 0.3%. The Cleveland Fed projected that it was going to be around 0.26%. 0.27% for the core inflation. And again, the core inflation, as reported in the CPI report, came in at close to 0.3%. Now, curiously enough, the discrepancy disappears when we look at the year-on-year data. And this is surprising because for many months, the Cleveland Fed's inflation nowcast has been fairly accurate, fairly close to the mark, much closer to the mark than it was this month for the month-on-month numbers. And so, when inflation printed higher than projected, this was an unusual miss for the inflation nowcast. Now, one reason why the monthly inflation numbers printed hotter than normal was because energy showed inflation rather than deflation. But that inflation appears to have been due primarily to the seasonal adjustment process. When we look at the raw data, the unadjusted data for the energy price index, we see that there was, in fact, deflation. We actually see that there was more deflation in November than there was in October. And yet somehow in the seasonal adjustment process, this deflation got turned into inflation. And again, curiously enough, when we look at the year-on-year inflation rate, that variance between the unadjusted data and the seasonally adjusted data, that variance disappears completely. Now, let's be clear. Energy prices did decline in November. There's no question about that. There's no mystery about that. Crude oil prices down for November. Gasoline prices down for November. Down in the commodities futures markets, down at the pump. Virtually every price metric for energy showed that there would be deflation for the month of November. So with all the actual market data showing that we have declining prices, the raw data, which shows energy price deflation month on month, is probably a more reliable figure than the seasonally adjusted energy price index data, which is showing inflation. And certainly the raw index itself is far more in line with the actual price data than the seasonally adjusted index. Yeah, we see this because we have this downward trend, this downward slope here. This is energy price deflation. This is actual declining prices right here. And when we look at the unadjusted data, November is a continuation of a trend that goes back to the earlier in the spring. Yet for some reason, the seasonally adjusted data breaks from that trend sometime in September or October. So this is not what we would expect to see from a seasonal adjusted adjustment calculation. And so again, energy price deflation is almost certainly the more accurate representation of the pricing data that we know is out there. Now, goods prices were another area of surprise. And for the same reason, because the pricing signals were all pointing towards there being more deflation for goods in the CPI report. Most notably, commodities, just like energy, were down on the month. Now, remember, commodities are best apprehended as the precursors to most manufactured goods. They are the raw materials for all of your manufacturing processes. So if commodities are down, my raw materials cost for any manufactured good is down, and so I should be seeing prices come down. I certainly shouldn't be seeing prices go up because of that. So with the commodity prices coming down, yeah, we should have seen deflation, but instead, and for the same reason as with energy, we saw inflation. And again, it was due to seasonal adjustment. But perhaps even more interestingly, that divergence in durable goods has been taking place for the past 2 months. And again, just as with energy, we see more deflation in durable goods prices in November than we do in October. And yet the seasonal adjustment goes from showing some inflation in October to showing greater inflation in November. So Why the change? Well, it's a seasonal adjustment process. That was why this data. That's how the one becomes the other. And so this suggests that maybe the seasonal adjustment process is off kilter a little bit. Maybe it's just an artifact of the month, but something is clearly up, because when you look at all the different pricing signals for goods, we're seeing more indications of deflation than inflation, and so it's unusual to see for the seasonal adjustment process to reverse that and go against the trend and show inflation. Non-durable goods were pretty much the same story. Again, how do we go from deflation to inflation? Seasonal adjustment. And again, this is not a normal type of thing. Normally, it's if the one is in deflation, the other is also in deflation. Now, as it turns out, it was only just a few months ago in August that we saw this kind of divergence, but in August we saw a little bit of deflation became a little bit of inflation. We're seeing much greater deflation, down about 0.6% month on month, became 0.4% inflation month on month. And we have to go all the way back to March to see a variance between the unadjusted data and the seasonally adjusted data to get a variance that large. And keep in mind, the whole point of seasonal adjustment is to eliminate that kind of volatility. So, when the seasonal adjustment process appears to add volatility, we should be questioning it. And again, as with energy and with durable goods, we're probably better off thinking that in non-durable goods, we actually saw some deflation in November rather than inflation. And we get more confirmation of this when we look at the base indexes. As we can see, the seasonal data for durable goods shifted from an deflationary trend, which has been, again, as with energy, this deflationary trend has been maintained for several months. But suddenly the seasonally adjusted data flipped to inflation. And again, seasonal adjustment calculations shouldn't buck the trend. They might narrow it, they might change it up a little bit, but if it's downward, if it's still downward pricing, it's going to be downward pricing even seasonally adjusted. It's not going to suddenly churn upward. The trend is certainly not going to reverse and head up in defiance of that downward trend. And when we look at when we look at the rest of the durable goods index chart, we don't see the seasonally adjusted data bucking the trend of the unadjusted data. That's just not something that's just not what we would anticipate. Same thing in durable goods is that in this most recent month in November, the seasonal trend bucked the unadjusted trend, and that's kind of not normal. That's not how things should look after the seasonal adjustment calculation is done. So not only are these indications that we're probably looking at deflation rather than inflation in these areas, and therefore this lowering the headline and core CPI values, this also suggests that there might have been a glitch in the seasonal adjustment process. Something the data, the seasonally adjusted data, may be uncertain. Now, another area where the CPI report is almost certainly overstating the case is in shelter. Now, keep in mind, the shelter component of the consumer price index tends to lag housing markets. It's the way the index is put together. And as a result, there's always a certain structural inaccuracy built into that part of the CPI. The rent inflation that the CPI shows is almost never the current month's rent inflation. It's a situation from a few months back. Again, that's because it's a lagging indicator. Now, we can get a sense of how much the CPI shelter price index varies from actual inflation in rents by comparing it to a more forward index of housing rents, such as the Zillow Observed Rent Index, or ZORI, which is maintained by real estate firm Zillow, obviously. And when we do, we see that we're dealing with different inflation curves. And to a degree, we should expect this. This is not surprising. But what it does show is that while the CPI shelter price index is still showing elevated inflation, the Zillow index, ZORI, is showing that we've been having housing disinflation for most of the summer here in 2024. And last month, we actually had deflation. Rents, according to the ZORI, went down. We don't have the numbers yet for November for ZORI. But if we're seeing this kind of a trend, then we should probably also be thinking that we have deflation taking place in rents as well. And every time where we have deflation rather than inflation, this is just an indication that the ultimate headline and core inflation data are being overstated. Now, even food price inflation really does warrant a bit of scrutiny here, because while the seasonally adjusted data does show the greatly elevated food price inflation that I forecast last week, the raw data is suggesting that there's a deflationary shift in food prices taking place. We had, on the unadjusted data, we had 0.4% in September. We had about 1.8% in October, and on an unadjusted basis, we had about 0.6% in November. And again, this is a trend. This is a downward trend. But again, we have the we have the seasonally adjusted data bucking that trend, going from low in October to a high in November. Now, if the raw data is showing that there's a long-term decline, the seasonal adjustment data should not be reversing that trend. Yet, it appears that is what happened. But and again, this is one of the curiosities that we're looking at. That variance disappears when we look at the year-on-year inflation rate. So clearly, food price inflation is still happening, and clearly, food price inflation is still going up. But it may not be going up and contributing as much to overall headline inflation as the CPI report might indicate. That there's the month-on-month figure for food, like many of the other figures, may be actually overstating the case somewhat. So what should we make of the CPI report? Is the data completely corrupted and tainted by poor seasonal adjustment calculations? Now, with inflation data especially, we should always approach the data with a certain skepticism. Even without anomalous results between the seasonally adjusted data and the raw price index data, the constant caveat with inflation data should always be your mileage may vary. Depending on how one shops, depending also in what part of the country one lives, the experience of consumer price inflation could easily be greater than what the CPI report shows. It could also be less. We shouldn't be surprised if it's different. Now, this does not mean that we should assume that there is no inflation being reported, because, as we can see, even on an unadjusted basis, we're still seeing service price inflation. It's been cooling off. We're seeing a little bit less of it on an unadjusted basis than we were, but we're still seeing inflation. It's still happening. Service prices are still rising, still going up. Yeah. And even when we look at the core and headline rates, we see the core inflation rate did not go down in November. It has not declined. And even though the headline inflation rate has gone up a little bit. So there's still inflation happening. Inflation is still rising. Even without seasonal adjustments, we're still seeing that. However, it may not have risen as much as the seasonally adjusted data indicates. It did rise, but maybe not as much. Now, there are good reasons to question the inflation data that is compiled by the BLS. And the flaws with how that data is seasonally adjusted is only one of them. Now, we certainly should not make the mistake of equating the consumer price index to actual consumer prices. It isn't. They aren't. Rather, the consumer price index is a broad brush overview of all consumer prices across the whole of the U.S. economy. And because of that, there are quite a few layers within that data. And within those layers, prices can move in all sorts of directions. And when we peel back the layers within the CPI data, we see exactly what I said would be there. We see that there is both inflation and deflation. We see that in the data because that is what we can see happening in the U.S. economy. There are prices which are rising and there are prices which are falling. That some prices rise and some prices falls tells us once again that the impact of deflation is most of all one of distortion. It's not just that prices are rising or falling in absolute terms, but they're rising and falling with respect to each other as well. If goods prices are falling, that's going to magnify the degree to which service prices are rising. That energy prices are falling is part of what makes us more aware when food prices rise. And so these are the kinds of distortions, these are the kinds of alterations in relative pricing that inflation inflicts on the economy. And this kind of distortion is part and parcel of how inflation damages in the economy by pushing it in directions it would not otherwise go. Now, the November CPI report does show that inflation is heating up. Consumer prices are rising. But if we peel back the layers of data, that report also shows that inflation is distorting consumer prices and damaging the economy. Yes, inflation is still doing its damage to the economy. And for all its likely flaws, that's what the November CPI report shows, and quite clearly. And that concludes this presentation. I hope you found this podcast helpful and informative. Please like it and share this with your friends. Word of mouth is how I publicize my work. Please also consider making a one-time donation or becoming a paid subscriber to All Facts Matter. Your support is what keeps this work going, and I greatly appreciate all of my subscribers. Without you, this work would have no meaning. I encourage everyone to be especially generous with feedback. Leave a word or two in the comments section so that we can keep the discussion going and that we may learn from each other. Thank you all for listening, and have a nice day.